So first of all, I want to talk about natural gas, and I've got the barchart.com study up here, and I've also got something I'll show you a little bit later on regarding the commitment of traders. But I want to show you what the news is saying here. October natural gas prices Tuesday climbed to a one-week high and settled sharply higher. Natural gas prices rose after the U.S. Department of Energy on Saturday awarded a 5-year contract for LNG to New Fortress Energy to sell gas to countries that do not have free trade agreements with the US. So quite a big deal there. And then last Wednesday, natural gas prices sank to a 4-month low. We saw all of that. It's been squeezing quite a lot of people out. And then we've got the commitment of traders report right here. But what I'm going to do is actually come back to this. Before I do that, I'm going to go to have a look at the futures prices, the forward contracts, and see what we've got lying ahead of us. So the current cash price is 2.21, and the current October front month, October, is also at 2.21. We'll go back to the chart shortly. But look at the big leap next month. At the next rollover, we go to 2.56. That's a 30-cent increase, I suppose. And then another, something like a 50-cent increase into the December contract. And then January just drops up. January is a little bit higher as well, actually. And then we sort of fade a little bit into the next season, the next cooling season. Or cooler season, or a warmer season, cooling season. So natural gas prices look set to rise up into the mid $3.50 region before January. So 3.35 in January, 3.24 in February, then it starts dropping off. But around about January, we've got the 3.35 to 3.40 level. These levels will change as time goes on. So the futures curve looks pretty good for natural gas. And then we did have a look at the COT report. And in order to, I've got the free version of this, so it's a little bit messy. In order to analyze this data here on the COT report, I've actually just pumped, this is one of the things you can do if you're a bit lazy like I am sometimes, take a picture of that screen and send it across to ChatGPT and see what they think. And that's exactly what I did. And let me just read this to you. I think you'll be able to see that on your screen. Hopefully you will. The image you uploaded provides a commitment of traders report and the seasonal chart for natural gas futures, specifically for October 2024 contracts. Here are some key insights. The seasonal chart. The price compares the natural gas October 24 contract price, trading at 2.2, just a bit of a bump. And then secondly, the commitment of traders COT breakdown. Long positions at 594. This suggests strong buying interest from commercials. We're talking about commercials now, with an increase of 18,000 contracts since the last report. Short positions, 516, roughly the same, slightly less. Commercials also have a large short position, but it's smaller than the long exposure. Not much, a little bit. I think smaller is more or less the same, actually. This reflects that commercials are hedging against potential downward price moves, but are more bullish overall. So they're retaining those short positions as a hedge, but generally angling towards the bullish side. Not much, a little bit, as you saw. 594 compared to 516. Then the non-commercials, the speculative traders like hedge funds and money managers, long positions 303 and short positions 395. So net long, speculators are net long of 303, but with an increase of 8,600 contracts to the long side. Short positions 395 with an increase of 19,000 to the short side, indicating that speculators are more bearish. That's us. That's the traders, speculators, retail traders. Normally these numbers, the retail traders don't make up a huge amount, but we're talking about the big hedge funds, the big banks, those people that are interested in trading the energies markets, generally slightly more to the bearish side, really, I suppose. Not much, again, more or less equally balanced. Call it 400 against 300. So yeah, 25% more to the short side. That's traders like us. We're long, but many people are short. Most people are short. This report came out on the 7th, so it's a few days old already. Sorry, not the 7th, the 27th. And then we talked about that. The producers, now, they have a significant long exposure, 228, and a rise in long contracts of 11,000, but they also maintain a short position of 280. Again, almost equally balanced, a little bit more to the short side. And then the managed money, not such a big group, well, quite big actually, 219, net long, but we've only increased by 76 contracts. Their short positions are bigger again, 291, with an increase of 31,000, suggesting growing bearish sentiment. So we've seen the growing bearish sentiment as we've rallied up into selling levels. Retail traders normally sort of ping pong from one extreme to the other. So as the market rises, most retail traders will start to sell. As the market falls, most retail traders will start to buy. And normally they're wrong. Normally it's a little bit, not necessarily wrong, but normally too early or too late, or just completely wrong, in the wrong direction altogether. So don't pay too much attention to that. And then the swap dealers have more exposure to the short side with a reduction in short positions, but not much to the long side. So they're also hedging against any potential moves up. So actually, the fact that they've got, well, this is not quite right. These smaller traders have more long positions, 83, than shorts, 104, but that's not correct. So ChatGPT can make mistakes. And then the assessment of this overall sentiment, bearish speculative sentiment, that's the traders. There's a strong increase in short positions by non-commercial traders, indicating growing expectations of continued price decline, and so on and so on. So in my assessment of the COT report, let's just go back there, it's a pretty mixed picture. More or less balanced, slightly one way or the other, depending whether you're looking at commercials, producers, managed money, swap dealers, etc. But not out of balance, particularly one way or the other overall, and just little bits up and down on both sides of the market. So ChatGPT is saying it's slightly bearish. It would be slightly bearish because the market's moved up and a lot of speculators and particularly retail traders will be looking to go short. So that's just a little bit of analysis on the COT report using ChatGPT as a friend. All right, you should be able to see the charts now. Yeah, you can. That's fantastic. And let's start with natural gas. We have a bit of a takeoff here. Let's go to the Henry Hub chart first of all. And I'm not going to sort of go over this again and again and again because I've done it so many times. And in fact, since the beginning, well, the middle of July, we've gone nowhere, absolutely nowhere. And I keep on saying the same things over and over again. There's the triple bottom that we're playing against or off against. There's the 786 and the order block and the gap that we tried to fill. Once again, didn't fill it completely. Then we gapped up at this rollover into the new contract, which is the October contract, November contract, October contract. Sorry, I'm getting confused with some other futures that I'm trading. This is the October contract, and we've rolled over into it. We gapped up slightly with that rollover. This is the Henry Hub. This is 15 minutes delayed. So what I'm going to do is go to my BlackBull futures chart where I trade my natural gas. This is the day chart. Let's have a look at the 4-hour chart. And there we've got this big 4-hour candle moving up. This is the Henry Hub price, the natural gas futures at BlackBull. But yeah, these futures roll over a couple of days before the Henry Hub at the NYMEX rolls over. So this chart can become a little bit messy. But for now, we're spot on with the Henry Hub. That's where it is. That's the real live current price. And we're just entering into this order block above us. We're trying to get up through there. 2.25, remember, that's the key number. That's this order block. If we can close above that red line, we're just about there now, actually. As I'm talking, it's moving up fast. 2.2, almost got to 2.24. That's the Henry Hub. Let's go and have a look at the spot price over at Pepperstone. And the spot price is still lagging. We've got 2.234 there, but on the spot price, we're still at 2.15. This means that we have to get up to match the futures price at some stage, unless the futures collapse, which doesn't look like they're going to. So the spot price at Pepperstone, a lot of you will be trading the spot price at your various brokers. You won't be trading the futures. With the futures, you need quite a large margin. You need a larger account, and you've got to deal with the rollovers every month and the gapping, and it's a whole different ballgame, and you trade each contract separately. With this continuous spot price at Pepperstone, there are no rollovers, but the price lags the front month and the subsequent futures months thereafter. So we get a bit of a lagging effect, and you can actually play that with a bit of, and I got a lot of flack about this some time ago. You can play this with a bit of arbitrage if you're smart. If you're trading, if you know how to trade the futures and you're trading the futures, you're observing the futures, but you're watching the spot price. If you happen to be trading both, which I am, I trade the spot price here at Pepperstone and at Oanda, and I traded over at BlackBull on the futures. So I can see all three of them, and I know which ones are lagging, which ones have got to catch up. And right now, the spot price is lagging the futures. So this probably will catch up unless the futures collapse. Target for this, as I said, let's go back to the futures because this gives us the clearest and most reliable picture of what's going on. The target here is actually where we are at the moment, 2.25. I want to see a close above there on a 4-hour chart, and then I want to see a close above there on a daily chart. So this is where we are on the daily. Notice on the daily chart, and this is over at BlackBull, this is not on the Henry Hub. This will look similar to the Henry Hub. Notice that purple line right above us, right where the price is at the moment. And notice as well that it's also the top of this green zone, this block here. That's the 61.8% Fibonacci of the last move. And the purple line that you can see right above where the price is at the moment is the 200-day moving average, 200 days. And we're just touching up against that 200. That 200 will provide resistance, but if we can break up through it and close above it, and that will also propel us through that order block on the 4-hour chart, this one over here that we looked at before, that will be pretty bullish, really, and pretty good for natural gas. Now, what I want to do is switch this back to the NYMEX chart, and I can never find this when I'm looking for it. There we go, Henry Hub. Let's just have a look at this on the day chart at the NYMEX futures and see where the 200-day moving average is. Slightly different compared to the BlackBull futures price, which is tracking the same price, but we have different rollovers. So this rollover here that you saw in the NYMEX, and that was on the 28th of August, rolled over a few days before that on BlackBull, and so you get a slight disproportion or slight displacement, I suppose, of the moving averages. So this is at the NYMEX. This is the chart we've been looking at the whole time, and you can see that we've got to get above all of this stuff here. I would say that we need to close, if we're looking purely at the futures on the NYMEX, we need to close above 2.3. That's this recent spike high. If you want to be a little bit more aggressive than that, though, and zoom into the 4-hour chart, you can see a close above this order block would be equally as good, I suppose, on a 4-hour chart. And the top of that is at 2.25. If we go to the day chart and have a look at that level at 2.25, what I'm going to do is actually just drag this red line down to 2.25. It's right there. And you can see why that number is actually more relevant than the actual spike highs or the wick highs of these candles, because it's the top of these candles, but it's also the top of the body of this black candle here. And when you go to the 4-hour chart, you can see there's actually a proper order block there, or structure, MSB, market structure break opportunity. So that's where we are. We're just looking for this to move up. If it doesn't, it's looking good so far this morning. If it doesn't move up, then we've got some problems lying ahead of us, and we're going to have to wait even longer for this to faff around underneath the 2.25 level. I don't think that's the most likely case, but we'll have to wait and see.
Natural gas fire burning bright, crypto's rising, taking me to new heights. Gold steady, it's my treasure trove. Hit the jackpot, feeling in the groove. Don't worry about nothing, just let it ride. These trades got me feeling right inside. Screens glowing green like a money machine, rocking the market like a fever dream. Tickers flashing, profits getting bold. See the numbers climbing, can't control. Elvis tunes playing, dancing in my chair. Luck's